2025 is really shaping up to be the tale of two markets. On one side of the market, we have explosive growth stock. Looking at the big tech names that we're seeing, AI driven leaders still dominate the headlines and have been capturing crazy amounts of growth within 2025. Now, on the flip side, we have the value sector. When we look at energy, when you look at financial, quietly gaining traction as the economy adjusts to these interest rates and the change in demand. And with the interest rates dropping, I feel like we could see a really banner year for 2025. So today I'm going to really break down what is happening between the growth side of it and the value side of it and show some of these top ETFs in each category, share some portfolios that you can build utilizing both of them. So whether you're a seasoned investor or brand new to the channel or investing in your first portfolio, this is the video that is going to give you what you need to make informed decisions in 2025. Now, if you caught any of my other videos, I do ETF investing. I do not buy individual stocks, which now we do have one, which is NVIDIA, the only one, and we're putting $10 in there every single day that the market is open. So starting to build a portfolio with the one and only stock that I have. So let's start with a quick refresher in here. Growth stocks. Now, these are the companies that we believe are going to grow faster than anything else in the market and really outpacing the S&P 500. These are the big companies we all well know, big tech companies, the AI innovators, cloud computing, electronic vehicles like Tesla. It is about rapid expansion and disruptive potential when it comes to these because investors are willing to pay for future growth. It means the P&E ratios or the price and earning ratios are usually going to be at a very high premium in comparison to the money they make. But even when we look at some companies today like NVIDIA, they are making a crazy amount of earnings with that cloud computing, also all of the semiconductors and everything else the company is doing. On the flip side of that, we have the value stocks. These are companies that are inexpensive when compared to really the fundamentals. They don't grow as fast as what we see, but these are the companies with steady cash flow, established businesses. They've been around for 50, 100, maybe 100 plus years, have and usually pay a strong dividend as a return. Thinking of your banks, your energy producers, industrials, consumer staples, these are the things you can't do without. Now, historically, growth tends to outshine when interest rates are a little bit lower, like what we're going into. The economy expands because money is a lot cheaper and money really fuels innovation. When you start looking at some of these big tech companies and even buying some of these mid cap or these small cap companies, they are just outright billion-dollar transactions where they're cashing out some of these tech companies that are the up and coming to make sure that they are dominating the landscape when it comes to technology. Now, value on the other side leads when inflation is sticky. When we see inflation going up, when interest rates are high or higher, market rotations, they are the stability and they produce a lot of income. When we start thinking of ETFs like the SCHD, very interesting to see how it is kind of all of the value companies and a lot of these innovative or really these income-based companies that are just building a big portfolio. So the marketing landscape, what does it look like right now when we think of the market? It's super interesting right now because the Feds cut rates in 2025, which is the first time that we have seen them in a while. Even though rates historically are still a little bit elevated, there is going to be a little bit of leeway. And the Fed also noticed we should see another 1 to 2 rate reductions in 2025, which is going to be interesting because that means tech dominance is still going to be alive. It's still going to be well. When we look at the Magnificent Seven, your Apple, Microsoft, NVIDIA, Amazon, Alphabet, Meta, and Tesla, they are still a massive portion of the S&P 500. They also possess a massive portion of the NASDAQ, meaning these really drive AI. They are the cloud computing. They are the consumer technology. And honestly, now when you look at pretty much every company globally, even thinking of a worldwide reach, most of these companies have some part of these worldwide companies, and every company through innovation or technology or even operating systems will fall somewhere in there. Now, when looking at the research from Wisdom Tree, looking at analysts are showing that energy and the financial sector have been gaining a lot of traction. Energy companies are seeing the stability of oil prices, global demand for it when banks and insurance companies are enjoying widespread margins. When rates are higher, and of course, banks with a higher rate environment, they do flourish. They don't have to pay money for those higher CDs. And honestly, looking at the rates that just came down that 1/4% from the Federal Reserve, most of the CD rates have already dropped considerably. Even looking at 0.5%, a percent, and some of the savings accounts at your traditional financial institutions have went back to the point ones or the point threes, meaning the rates for there are absolutely gone. So think of it really both sides of this coin. High flying stock growth on one side with these tech companies, and of course, the cut of the interest rate. The other side of it is the steady cash flow companies within the value sector. So let's break down the growth one first. Now, of course, growth in the market is where I invest all my money, knowing that it is 20 plus years to retirement. Thinking of some of the most and really widely innovative ETFs that we have. First one, of course, the Investco QQQ. This tracks the NASDAQ 100. I hold this personally as the biggest part of my portfolio, heavily weighted towards all the big tech names, Microsoft, Nvidia, Apple. Interesting with this one is it excludes the financial sector, which we know is kind of on that value side. Also thinking of the Vanguard Growth ETF or the VUG. This is again, large cap innovative exposures, not quite as much of a concentration as we see with that QQQ, still heavily tilted towards the companies that have a very strong earning momentum. And also the P&E ratios on these are getting a lot higher. And then the interesting one, and if you know who Catherine Wood is, the ARK Innovation ETF. This is one where if you have a very high tolerance ARKK focused on disruptive innovation such as genomics, robotics, and future tech companies, fintech companies that are up and coming. For me, the ARK Innovation ETF is a little bit too much risk for the portfolio. I would rather stick with the first two. Knowing that we have the QQQ, I do like that as an innovation. And you really have two choices to do this. One, you can do a foundation like a VOO or a VTI that covers the entire market itself, putting 10, 15, 20% into growth, very similar to what we see with the QQQ or VUG, could really benefit if tech continues to run. So with the powerful upside of this, again, thinking of technology, thinking of AI, if it continues to deliver in 2025, even going into 2026, that means the valuation could go up even higher than we've seen it over the last 2 years. But remember, with the risk can come the reward, or it can come the downside. If we see a tech pullback, these are going to get hit a lot more than our stability funds like that VOO and the VTI. Now, the flip side of this in the value sector, there are really a few that stand out. The Vanguard Value ETF, which is large cap fund, but it gives you exposure to multiple companies across a ton of different sectors. We have the Energy Select sector, or the XLE, major role in those US economy, such as ExxonMobil, Chevron, benefiting from resilience within the global demand when it comes to the oil. And then we have the financial sector. And again, I focus on these specific ETFs because I do not buy the individual companies. Looking at the financial select sector, Spider, on the XLF, this focuses on banks, insurance companies, capital market firms that will profit and are profiting when interest rates are elevated, just like we're seeing right now. Now, the value ETFs do offer a considerably higher dividend because when we think of the tech companies, they are reinvesting all of their earnings like we traditionally see. Like I said, on the flip side, the value side are these companies that have been around for an incredible amount of time, and they do pay a higher dividend yield, looking for income, looking for stability, making this and building it as part of the portfolio could really make a big difference. So now the big question, how do you choose? Do you choose one side? Do you choose another? Most investors, including myself, use a blended portfolio or a core satellite strategy, which this means having something like the VTI, like I said, or the VOO, making sure this is kind of the core of your investing portfolio in its entirety, adding satellites 10, 20%, maybe putting 50 into the VOO, putting another 20 into something like the QQQ, putting something like 10 or 20 into part of the value, and then maybe doing something that is kind of a weighted index, which of course has kind of a blend versus it being heavily based on the market cap like the VOO. There are a few like the Investco S&P 500 equal weighted ETF, which takes all of those 500 companies and you get the same percentage of every one of them, because that means you don't have a very heavy tilt into these mega cap tech names. gives you a bit more weight in a lot of different sectors, which can kind of level out that portfolio. But of course, the big part of this in the strategy that brings it all together is dollar cost averaging. Setting a set amount, which I do every single Monday, and investing it into the market. You're not trying to time any of the market at all. It is about the time and the consistency of investment, making every dollar count. And it doesn't matter if the market's up, doesn't matter if it's down, you are still investing on a regular basis. So that's the story of 2025 when we think about it. Not just about chasing those big AI breakthroughs like what we've seen, loading up on those energy stocks. It's about understanding the balance that we see between the growth ETFs and those value ETFs and how you can use them to really achieve both parts of the market that we see it. So what do you think about the valuation that we're seeing today? Is tech going to keep running the show in 2025 going into 2026? Let me know in your comments what you guys think. If you found the video helpful, definitely give it a like, subscribe to the channel, share it with someone who has these same questions. And always remember, guys, these videos are educational purposes only. I am not giving personal financial advice. Always do your own research or consult with a professional before making any investment decisions. And I'll catch you in the next video.